Well, appreciate everybody being here. We keep trying to figure out the right amount of people to let overbook to get the seats just full enough. We're always worried because if everybody who registered showed up, we might have a problem. So that's worked out fine. I understand the food was just about right, so that's good. I think maybe we've solved that mousetrap. So Amy had surgery on a deviated septum, so she wasn't able to make it, which is really sad that she's not here to participate in us finally getting the food right. So I feel like I'm going to switch this real quick. Sorry. Yeah, it's not a fun surgery. Is that what you said? Yeah. For those of you who know Amy well, she's pretty tough. And she said that had she known how bad it was going to be, she wouldn't have done it. So pretty difficult. But well, I'm going to jump right in. I have too many slides to go through today, so I might run a little late, but I'm going to try to make sure that I spend time on the important ones. And I won't be talking a whole lot about what's going on in the geopolitical situation today because I haven't had enough time to research it, and I'm not smart enough to answer that off the cuff. But here's our loose agenda for today. Obviously, when we talk about international stuff, we'll get into some of the things that are happening today as well. I wanted to start with company updates because most of the time I do company updates at the end and you guys are all over me and then you get out and you don't listen to that all that much. So just a couple things that I wanted to touch on there. First off, it's not uncommon for me when I come to these events to hear people talk about how we have a lot of people in the room, and obviously that feels great. And some of you say it, I think, because you're happy for us, and that's really meaningful that people care enough about me to feel like they're happy that the business has grown. At the same time, that comes with its set of challenges, and we want to make sure that we hit those challenges head on. We do client advisory boards. Some of you have had a chance to sit on that, and we'll continue to do those and give more people opportunity to do that. But that's a time where we take 10 or 12 folks to a third party to ask questions and learn about what we're doing well and some of the concerns. And the size and scale of the business has been a reoccurring theme that people have concerns about, just to make sure that our service doesn't drop. And so, there's a lot of folks, and we want to make sure that we maintain a level of service that people have come to expect. We've tried to address that through our advisory teams, which is just the idea that no longer can one person wear all the hats and do everything. We need to have a little bit of kind of team work underneath each of the advisors who's your primary advisor. And then everybody has a primary wealth strategist. For those of you who work directly with me, that's Adam or Chapin if you work with Robert, and we have other folks as well. So I just want to invite you guys to take advantage of that. I also, just want to say that we don't always know when people need to talk to us, right? We have a cadence of our follow-up that we feel like fits the situation that you're in and the complexities or the milestones that are happening in your life. But we always want to invite you to reach out when you need to talk to us. Our sequence of, some of you here don't want to talk to us. There's somebody in the room who came in for a review a couple years ago and said they didn't even know why they were here and they didn't really need to talk to us at this point. And other people want to see us quite a bit. So I just want to let you know that we've built the teams underneath each of the advisors to be able to handle both specialties in their role and also the needs that you all have. And we have obviously phone calls, we have virtual, we have face-to-face, we have these that address broader topics. So again, just want to let you know that build out is there. We did hear that people don't want to talk to somebody different every time. That's why everybody has a primary wealth strategist. So we try to make sure that to the extent we can, obviously people move through the organization, but to the extent we can, that you have somebody that you get familiar with, that you can talk with on a regular basis and can help liaise all the other things that you might need, whether that's your advisor or the operations team for things that are more Schwab related, all that kind of stuff. So just invite you guys to take advantage of that. The Food for Thought expansion, you can see the room is getting pretty tight. We're looking for additional venues for two reasons primarily. One, we don't want to turn people away. I guess three, maybe two, is I don't want to do multiple events like I used to. Back when we didn't have this space, I did 3 of these a couple times in one day to accommodate everybody so we could fit you in. So we're looking for good space. it may be that we have to end up moving to a hotel, which is kind of our last hope, but we're trying to find that. The other reason is people have asked a lot over the years about bringing people to these events. And I just want to make sure you know, our intention is that you can bring anybody that you would like to, obviously within reason. Nice people, preferably over age. So that, if you have people that you want to introduce to us, obviously that's incredibly flattering. We've grown our referral portion of our business a lot over the past few years, and thank everybody who's helped us do that. We want to make sure you get a chance to share education if you feel like that's valuable. So we'll continue to work on that. Friends of the family, we did that last year. Again, this year, this is just to recognize those of you who've referred clients to us. It's just an annual event that we're doing to just try to show our gratitude for that. So they're pretty fun. So if introducing somebody to us because you think it'll help them or help us isn't enough, there could be a fun event in it for you too, if that's extra motivation. And then advanced planning. As we think about, our service model has definitely changed over the years. Part of that's just because as many of you in the room have grown the amount of wealth that you have, things have changed, your life has changed. I say a lot of times to prospective clients that people oftentimes don't change advisors because there's a problem, especially people in your demographic in terms of the wealth that you had or that you have. I know today that was a Freudian slip based on today. Goodness, you still have lots of wealth, I promise. Unfortunately, I think the last time I did this, the market was awful, and today I think it was coming back a little bit. I haven't checked in the last handful of minutes, but anyway, so as you have grown wealth and your lives have changed, I say to people that they change because their life gets more complex oftentimes, not that there's a big problem. And so we've continued to try to add things. Long-term care is not something we've done a lot of as a firm because we just think it's been very expensive. There has been innovation in the space. This is not something we think people necessarily need to do, but you may want to do. Charitable giving has become a much bigger deal. And then I'm going to be reaching out, not in any particular order, but just kind of to try to figure out some test groups. We're considering bringing on a retirement coach, which is non-financial related, just to help with kind of purpose and legacy planning, not necessarily from the money side, but things you may want to keep alive in the family. And I have a few folks that I'm interviewing and may want some of you, if you're willing to go through a process to both hopefully benefit, but also give us a little bit of feedback. So we'll be reaching out on some of that as well. So let's dig into the meat here. So I want to address something I'm going to talk about kind of macroeconomic conditions. I want to address just something we hear a lot about, which is the idea of a K-shaped economic recovery. And the importance of this is just to understand that not everything in the economy moves together all the time. And right now we're in a period where we're seeing more diversion in certain parts of the economy recovering at a different pace than other parts of the economy. It's one of the reasons why, you'll hear from me, relatively consistent ideas about, I don't want to say mistrust, but I'll say skepticism with respect to the media. Some of you have noticed that I'm a little bit sunburned. I was in Austin, Texas for a race, and I was listening to the news, which I don't do all that often, but there were some financial shows on the news, and it blows me away, the gross generalizations and the fear-based things that we hear as motivation to use a financial advisor or buy a product, right? Oftentimes the fear, I think there was something recently where this person was all over the news and they were talking about the gold, the situation with gold, and they had their title was economist, but then come to find out they make their money by selling gold, of course, right? So this is true, and it's also true from a consumer standpoint. We live obviously in a highly consumer-driven economy, and we're seeing a pretty significant divergence in how fast different socioeconomic groups are recovering and dealing with the current conditions, right? Fortunately, in this room, I think that's the clicker, yeah. You represent this top line. A lot of that is because of the difference between market growth and wage growth. And this is definitely a concern from an economic perspective. We see people that have money, who have money invested, have done very well because the markets have continued to do well. Although I would say oftentimes I hear about like this bull run that's never stopped. We were down 20% in 2022. That wasn't that long ago. So we have not just been on this progressive bull run with no negative markets. We just had one pretty recently. That doesn't mean we're not, headed for another one, or that we are headed for another one, but it's just a bit of context. That being said, people with money have seen advancements in their wealth. People relying on wages haven't necessarily seen that. And the buzzword that we've heard around, really continuously is inflation. And folks that are relying on wages to keep up with inflation have had a much more difficult time, recovering. This is pretty interesting, and there's a part to this slide that I want to make sure I close the gap on. But this is, again, kind of some of the reason for concern. What you're looking at is 2005 versus 2015, where the concentration of wealth exists, right? And there's a word that I'll use a little bit, which is correlations. But the concentration of wealth, as you can see, has moved more towards the highest or the top 10% of wealth in the country. So the wealthiest people now retain another 3.5% of household wealth relative to what happened in 2005. What didn't get put into a graph, which I probably should have though, is that the peak, this is not the peak. This has not been a progressive trend up. The peak was 2000, 2001 actually. And so since then, we've actually seen a slide back towards less wealth in the hands of the top 10%. The only reason I think that's important, again, is just to think about what we hear from the media. I think the narrative is that the wealth gap is just continuing to get bigger and bigger and bigger. And, maybe, candidly, I didn't do this graph at the top 1%. Maybe that group is getting, the dispersion is even larger. I'm not really sure. But I thought it was interesting just to think about the fact that although we have seen over the past, 20 years, so I think I said 2015, this is 2025, just to clarify. Over the past 20 years, we have seen a greater concentration of wealth in the top 10%, but it maybe not as much as oftentimes we might think. That's always a conversation that brings in the Fed and the dual mandate and the two things that obviously the Fed is really concerned with, which is inflation or price stability and employment. And so when we think about these two things, I think the narrative has changed some over the past bit where, a few years ago, everything was inflation, right? Every time I got prepared for one of these presentations or brought somebody in, the topics that we were talking about was consistently talking about inflation. And over the last, short period of time, that narrative, if you, are one of those people who turn on, the financial news every day, anybody still do that even all the times I've told you not to do that? The narrative has shifted a little bit more towards jobs and employment. That, inflation is reasonably under control. It's still not at the mandate of 2% that the Fed really wants, but obviously we saw rates decrease under the assumption that inflation is much more in control. That's probably part of the interesting thing about what's going on today with oil prices, and see if that's, what impact that is going to have. Why are we talking about wages? There's reason to be concerned, or employment. There is reason on one hand to be concerned with employment, because as you look at this graph, this is new jobs added. And if you just kind of focus on the far edge of the graph, you can see that since COVID, we've seen a decline in new jobs added. So that would be a potential cause for concern in terms of the fact that the economy is adding less jobs. For a lot of people, this brings into the question of AI. I would argue we're probably not far enough along the AI curve to have seen significant impacts in the job market as a result of AI. Who knows what that's going to be? I've shared this with some of you. It's just kind of an interesting anecdote. I was in San Diego at a conference, and one of the speakers was one of the founders of OpenAI. His name was Zach Kass. And when I saw that the afternoon was going to be filled with AI speakers, I, reserved my spot at the bar, because I figured I'm gonna leave this not feeling really good about the future. And really interesting. Makes you think that at least for the people we got to hear, there's some people at the high end of AI and what's happening that are, I guess I would say, really thoughtful and seem to have really good intentions about where AI goes. There's obviously lots of concern about whether, my bot is going to take advantage of your bot, or if there's going to be nefarious activity. And I've heard lots of different stuff about that. But one thing that one picture that Zach Cass painted was just how beneficial AI will be in the fact that the cost is so much lower than other technologies. Many of you know this, you're using AI for free, in large part, or you're getting pretty advanced versions of it without paying a whole lot. So there is some implications to the wealth gap that AI, potentially will be able to even that. He also, I'm paraphrasing, I don't remember exactly how the story went, but he told the story that he's obviously ultra wealthy. He has a family office, which is these ultra high net worth, like legal teams and tax teams that take care of really wealthy folks' money. And as the story goes, he did a presentation for them. And at some point in the presentation, he asked them to raise their hands if they thought the world was going to be better in 10 years. And very few people raised their hand. So he finished his presentation, and at some point later, he fired them, because he said, I don't want the people handling my money to be a bunch of pessimists about where the future is going to be. Thought that was kind of interesting. And he really believes that AI is going to cause people to get out of their screens, believe it or not, because it's going to be autonomous, and you're going to be able to talk to AI much more than having to be looking down at something all the time. So I don't know. For what it's worth, there were some potential positives for those of you who watch the news. That being said, we see this decline. However, on the other side of that, believe it or not, unemployment sits around 4.4%. Our average going back to 2005 is 5.8%. So even though we have seen a decrease in the number of jobs from, oddly enough, from an unemployment perspective, we still stand in a relatively good spot when we go back and look at where we've been over the past 20 years. So, it's not uncommon for lots of conflicting data, right? And that's one of the beautiful things about data, I think, on some level, is it isn't necessarily telling you what is going to happen, but it's at least drawing into question what people say is going to happen, right? And we obviously see a lot of that today, right? If you think about what's going on today, it's pretty common for us to go through these behavioral cycles in the market when we hear news or have negative things come out, like we just had over the past couple of days in terms of what's potentially going to happen to oil and the conflict, that people are worried about. You see a lot of behavior in the market that drives short-term problems. Although the last couple of times this has happened, the 12-month return in the markets has been pretty good. It's important to remember the consistency of returns. We can't use any of the data that we just looked at to be predictive. You guys know I'm never going to get up here and tell you we're going to predict something. But a couple interesting pieces of data. Oh, this looks like it's not cooperating. That's pretty faint. But stocks and bonds are positive together 70% of the time. Stocks and bonds are negative together only 10% of the time. We saw that in 2022, where we saw bad markets in the equity space and in the fixed income space. But it's, more often than not, if we're playing statistical probabilities, we have a better chance in most years to get positive returns if we're staying invested. There's a number of places that we can look at, and this, from my investment committee research team, looking at a variety of different things that we use. I think that we invest with rules. Right? We have predetermined rules that determine kind of the non-emotional decisions that we make as investors of when to buy things or when to sell things. But we also put macroeconomic conditions into the mix potentially on a quarterly basis. That doesn't mean we're always going to do that. It means that we're looking to do that potentially. And these are some of the areas we look at: inflation, savings rates, corporate profits, leverage, bond yields. The message here is, I think, and I'm going to show you a little bit of kind of some of the conclusions more from a data perspective, but you do get that conflicting information where the data in one space may kind of represent a more bullish indicator, and the data in something else may indicate something that seems a bit more bearish. So we have to be thoughtful about how we take all these pieces of information and implement it. It's dim switches, not light switches, right? It's movements that are subtle. It's changes to targets. That's been super beneficial for those of you who've had a chance to review performance over the past 12 months. Some of the things that we've advocated staying the course with have manifested. And we know everything is a probability, so it's not going to be there all the time. We have to make sure we stay in places to take advantage of probabilities when they exist. Which is a good segue into the market discussion. So this graph here, they used to let us put the names on it. You guys may remember this from last year, but our compliance team that's affiliated with DFA, Dimensional Funds, you can see down there at the bottom, which is also the connection to the University of Chicago, has said we can no longer put the names of the banks who put these predictions. But in the late in the year, the banks give their forecast or their projection for what the market is going to do in the upcoming year. And this is the list of the 18 biggest investment banks and their forecasts at the end of 2024 for what they expected the return of the S&P 500 to be in the upcoming year. This is quite a bit better. Three were above. This is last year, nobody was even close. And this year, there were a few that actually predicted higher. But you can see, again, you're talking about the smartest research teams. I'm always shocked when I hear people talk about either what they've heard from economists who may sell gold as their real job, or from advisors that they have, or firms that they're with. This is particularly, what's the word I'm looking for? Consistent, or it's something I hear a lot when I talk to prospective clients, when I might ask them about why they're with the firm that they're with, and oftentimes intelligence is the reason. They're really smart analysts, really great people, right? And some of you have probably heard me say this before, but the reality is the best performing banks and funds last year had really smart people from great institutions, but so did the worst performing funds and banks last year. So intelligence is not a differentiator, and with AI probably becoming even less so. But you can see the vast majority of investment banks are not predicting all that well when it comes to the performance of the S&P 500. This year was much closer. If we get back and look at more of a historical account of this, the green is the actual, and then we're looking at the highest, the median, and then the lowest predictions of any of those banks. And you can see in years like 2021, I've got to tell them they need a new color because it doesn't work on this very well, but 2021 and 2022, nobody was even close. Last year, again, was another year where nobody was even close. It begs the question of if they were tired of getting killed by being too pessimistic about their, forecasts, and decided to just raise the forecast to see if they might be a little closer. Lo and behold, a few of them were close. But you can see, the median is still below, and some people really miss by a long shot. I always think that's interesting. Some of the narrative around that, and you can tell, like we've talked about this before, but I guess I digress for a minute. Part of the reason I like to say this, point this stuff out or have a conversation about this portion of the information that we see is just because of the sheer volume of information we're getting, the 24/7 news cycle, and the certainty with which people say the things that they say, right? I told you I was in a hotel room listening to the news, and one guy got up and he said, taxes are going up. Every single one of you should stop contributing to IRAs and 401ks and put everything in a Roth. And that is such a wild generalization. I mean, for a lot of people, that could be true. I flipped the station, and the next guy is saying, this is the most difficult time in the history for people who are retiring. No offense, but why? Because we've had 20% returns in the market for the last 3 years. I'm not sure that this is the most difficult time ever. And I don't know that that's not true, but you can see this is what JP Morgan said. Polarized regional equity performance will persist. U.S. equities will be preferred over the Eurozone. That's what they said at the beginning of the year. Europe beat the U.S. by 15% last year. The next quote is from Deutsche Bank. 2025 will be a clear case for a strong economy with a strong currency for the US dollar. And the dollar was down 6% last year. And then the last one, China will be incapable. This was from Morgan Stanley. incapable of providing sustainable economic recovery or a stock market breakout. And China beat the rest of the world by 8%. These people are really smart. They have really good reasons why they say the things that they say, but they just don't know. And when we look at last year, I know some of you have commented to me about my slides over the years. I'm not building slides for aesthetics all the time. I have teen girls. Does anybody have either teenagers in their life somewhere where they use the word aesthetic all the time? Every year it looks like this. This is just all the major milestones throughout the year that cause markets to move around, right? The big one to just be reminded of, and maybe that's good for today, is April, right? When we look at what happened in April, markets took a huge slide. We got close to a 20% decrease in the broad markets for a really short period of time. I've told some of you this, but I was at a conference in Northern California, and the market had slid like 3 days in a row by 1,000 points. And my wife comes on this one conference a year. My wife always goes with me. And I told her, I got to get up early and I got to go write something because we got to get something out to our clients because the market's been nuts for 3 days in a row. So I went and found a quiet spot. We were at a pretty cool space, and I went and found a quiet spot. I spent like an hour writing down some thoughts, and that was the day the market bounced by like 3,000 points in a day. So I literally got back to the office, or to my hotel room, and I was just like, none of that is worth it. But if you can, I find this a lot of times. I was in the business in 2008, and I feel like oftentimes people forget how bad 2008 was. When they talk about even COVID or 2022, people, think about how bad things were. But having been in the business in 2008, I can tell you that was awful, right? I mean, the banks failing, and we had this thing called the implodometer, which ranked which banks were most likely to fail next. That was just really crazy time. And so I think, you can think about that a lot of times in your life, right? Where looking back on things end up being a little more fond than maybe they were when you were there, right? You have kids, you see little kids and you're like, oh man, that was so great when you had little kids like that. And then when you were there, you're like, would you just go to sleep so I can just relax for a little bit? Well, if you remember what it felt like to be in April, it was crazy, right? The markets were falling really fast. There was tremendous volatility. Of course, the media was jumping all over it. And we had this brand new thing, at least in most of our lives, to the level that we've seen them, of tariffs that are going to cause havoc. And it was really easy to convince ourselves that over the next 12 months, the markets were going to be really awful and tariffs had just begun, right? That we were just now seeing the impacts of tariffs. Confirmation bias sets in for anybody who doesn't like the current administration. Now you're feeling like, I knew it, this was going to be terrible, which is not a political conversation, by the way. I'm just saying this is like the human psychologies that settle in. And then we look at the returns of the countries that had the most significant U.S. tariffs, China, Canada, and Mexico, and there's their returns respectively. So China was up 31, Canada was up 38, and Mexico was up 54% last year. Despite the fact that people claimed that they knew exactly what the impact of tariffs were going to be, we saw the three countries that had the largest tariffs from the United States outperform the United States from a market perspective.
This is stock market?
Mm-hmm. Which brings us to our one mistake last year. We did not put all of the money in Colombia. They were up 100%. This is just all the country returns. If you've seen us do this over the years, you can see. Sometimes I feel like I should give credit to Robert in the back because he always goes through these presentations with me and he comes up with funny stuff that I get to land and then he doesn't get the chance to get any. So Robert, thank you for that one. Anyway, you can just see the, kind of again, the dispergent returns across a lot of different countries, where the global economy was and how many countries did far better than the kind of broader based MSCI global indices. Which leads us to performance over the year. U.S. stock market up about 17, international developed at 31, emerging at 33, global real estate bonds, global bonds, right? Everything did pretty well last year, so it's one of those 70% years where or 70% of the time where we see positive returns. That kind of ties you into the 10-year. You can see if you look over here on the left side, like just on the side of that line, bonds have still been pretty tough over the long year periods of time. We look at, bond returns over a 10-year period. We're still at a point, just over 1%. You can also see that the U.S. market stands at a 10-year return to 12.5%. I've tried to point this out before, but I want people to make sure you understand. 12.5% is not your expected return in U.S. stocks. If you look back for 100 years, your expected return is closer to 10%. So we are running above return expectations. All that means is if we see a pullback in the market, you still are going to be reasonable and rational to have the same long-term return expectation because we're higher than we have been historically for these periods of time, right? If we were sitting at 9%, over the past 10 years, and then the market pulled back, then you might be like, oh man, we're going to have trouble hitting that long-term return because we're already below. There's some margin in your ability to still receive a long-term historical expected return based on where returns have been. That's not to say it will happen. That's just consideration if we go through a pullback. One of our objectives with all of you in the room is that pullbacks don't change your spending, right? I've said this a lot, but I go home, tell my wife and kids that we spend too much money. I go to work, try to convince all of you to spend more of your money, right? And I don't want you to feel like you need to stop that because the market pulls back, because within that 10% expected return is baked in horrible markets, right? Those are all baked into that return expectation. We obviously had a year that was, a little different when we think about commodities, right? There's been lots of talk about gold and silver. Again, you can see how the media jumps all over this stuff. Really good returns there. It only took 20 years to finally get some good return there. I remember when I was in the business and people were giving out, I went to a conference where the guy gave us pieces of silver as like he was doing something really nice for us to give us a piece of silver that was going to be worth so much. And it was worth not a lot for a long period of time, but I'm going to take it back from my son now that it's worth a little bit. If you look at the 15-year, you can still see, though, we got to be careful to jump on stuff. We have commodities in many of our portfolios, so we do have exposure there, but there's still a longer-term return that equities, would be a leader. Uh-oh, that's not right. We'll start there. Okay, so we look at the S&P 500. It was a pretty different quarter of returns, right? We saw first quarter down because of what we saw at the end of the quarter because of how bad returns started to be. We saw a positive second quarter at 10.9, a little bit lesser third quarter at 8.1, and a fourth quarter at 2.7. When you put those all from an annualized perspective, the S&P was up around 17% for the year. It's important in this discussion as we kind of get into valuations and some of the Mag 7 and some of the AI bubble, which is less talked about right now because obviously what's going on in Iran, but has been a big part of the narrative. The breakdown was 64% of the stocks in the S&P were positive, 30, 64, and 36, okay? For those of you who have our tax-managed stock portfolios, this is one of the reasons why we look to tax loss harvest, because when you own funds, you don't get a chance to take care of the ones that or take advantage of some of the benefits of having the negative ones to offset the tax consequences on the ones that are positive. And it's also important to, maybe a question. So Coke or Pepsi? Who thinks Coke was positive? Who thinks Pepsi was positive? Coke. Yeah, Coke was positive, Pepsi was negative. And you can go across the board. Verizon positive, T-Mobile negative, right? So when you start to think about this stuff, one, if you really start to look at the stocks that are in the positive and negative, it can do a good job of helping you kind of look back with hindsight to realize how difficult it is to pick the ones that are good, because a lot of times it just kind of defies your thoughts about why something would be what it is. And it's also kind of interesting to see that you see big kind of disparity across, two companies that are effectively in the same, the same industry, the same sector. So the distribution of these returns was mostly normal, except what happened out here on the far right side. So what this graph is showing is how many stocks were more extreme than the next, right? And you can see on the red side, there were very few stocks that really dropped significantly, 6 that dropped more than 40%. But you can see as you look at the positive returns, there is that kind of abnormal change at the very edge of this graph where we see a lot of companies that did a lot better than 40%. That's a bit abnormal, which obviously sparks a conversation we've seen over a while about the Mag 7. To draw a correlation to what I think we see, just kind of to take you back to the internet, right? This is similar to, in my opinion, what we see with AI, which is how do you invest in AI? How do you invest in the internet? Right? You didn't get to invest in the internet. What you had to do was you had to pick a bunch of companies that might have had their clause or were in that space, right? And you had to hope that the companies that you tried to invest in actually did give you exposure to the internet, right? We had companies that were in the toy making business, in the book making business, in the pet services business, right? And then you end up with Amazon that becomes the behemoth for quite a long time, which was not in the internet business, right? And so I think it's going to be very similar when we think about, all of these companies that we now know have big influence to what went on in quote unquote investing in the internet. It's likely to be very similar when we get into what's going on in AI, right? How many people, I don't even know how to phrase this in a way that wouldn't be giving the answer away with the question, but raise your hand if you think NVIDIA is less than 10 years old. Okay, good, smart room. So NVIDIA is 30 years old. Many people do not know that. Jensen Huang has been the CEO for 30 years. It's estimated that 90% of his wealth was created in the last 3 or 4 years, right? So who knew, right? Who knows who is going to be the next companies to drive, significant investment in the AI space. Furthermore, who knows where they're going to be domiciled? Right, so this draws into a question a lot of the things that we've heard over the years. You've seen a lot of people leave international investing. We're going to talk about that. We did not intentionally leave international investing under the assumption that it's all driven by U.S. multinationals. And you saw from returns earlier that there are some pitfalls when you make that type of decision. If you take the conversation of, hey, this space of AI is coming up and I got to figure out how to invest in it, and you use the internet as a relative kind of comparison, and how did I figure out how to invest in the internet? It was companies, most of which I wouldn't have known would be the drivers, right? Maybe Microsoft, some of those ones that you might have known would be there, but some, of course, we didn't even know were going to exist. This in 20-year rolling periods going back to 1927. At the beginning of the rolling period, there are 3,000 stocks. By the time you get 20 years out, 40% of them are still around and only 18% of them actually beat the index. So it just illustrates how difficult it is to pick them. Now we know these ones are the ones that are being talked about. This is the Mag 7, right? These are the ones that we're thinking about whether we're in an AI bubble. I mean, the first question you might think about in terms of some of the things that I just said is, are these AI companies, are they the AI bubble, or is it just high valuations? I don't know. But if you look last year, the S&P 493, those companies without including the Mag 7 were up 15.3, the Mag 7 were up 22%. So you got premium, you got extra return from what you got from the Mag 7, but also you could argue it was more the Mag 7 outperforming, not necessarily poor performance from the rest of the market, because as we talked about, they still outperformed by 4 to 5% from their historical average. And if we look at these particular companies, one thing, and we'll continue to talk about valuations, they were high last year too. Right? So in other words, if you had believed the hype that these companies had valuations that were so high, hopefully everybody knows what I mean when I say valuations, but They're generally priced to earnings, so what the price of the stock is for each share of earnings that you get, and price book ratio, which is more prices to the actual assets that the company holds, just to give context a little bit. But when you look at those companies, many of them had very high price to earnings going into a year where they outperformed their peers. Again, it doesn't mean that it's going to be the same next year, but now we're moving into AI and all the crazy things. Robert told me today that he saw a video on the internet of George Clooney and Brad Pitt getting into a fight. I don't know if anybody, I didn't see this, but supposedly it looked really real. When I was at this conference, they showed a video of where Jensen Huang had a large, he's the CEO of NVIDIA again, just to remind everybody. So he had a large webinar that he had for people, and AI did a fake webinar at the same time he did his live webinar. They started out by saying, you got to be really careful about fraudulent forms of this. And from what I understand, the fake one was better attended than the real one was, right? So these are definitely some interesting things we have to get through. From what I understand, AI can't get fingers right. And we have these different places where AI is kind of starting to take shape, right? Applications, infrastructure, the AI models, chat, OpenAI type of stuff, and then the semiconductors. You can kind of, I think sometimes you can hear bias to some of these conversations within the media. Semiconductors certainly has had its time where that's all that's been talked about around the AI space, but this is kind of the question. So it is true that valuations are high. These are the Mag 7 valuations relative to the S&P 500, U.S. small cap, and U.S. small value companies. So there's a lot to potentially glean from this. One is it's not a mistake to rationalize that they are potentially valued high. I'm not going to say overvalued because we don't know. It's one of the questions about AI, because I've said this before, but we don't really know what AI is going to do to expenses or what AI is going to do to efficiency, right? Keep in mind, at one point, we had a lot of steel workers that we don't have today. At one point, we had assembly lines that we don't have today. Nobody knows what it's going to look like when AI, has the impacts that it does. But we can see that there is a relative, disparity for the Mag 7. We can also see that it could imply that there is value in other places, right? The reason we use tolerance band trading is to force ourselves to consider assets that aren't priced as high as other things without letting our behavioral biases come into play. And you know that from the work we've done with the University of Chicago, that small companies, even though they have underperformed as of late, are a big part of what we do. Small has underperformed large in the broader category. It doesn't mean that there hasn't been advantages to small in each asset class, which gets a little bit more nuanced. But so that could also imply that. Here's the thing about the bubble, though. This is what we hear a lot. And so the best place to go back, right, the last bubble, which is the tech bubble, this is showing the earnings of different sector or segments of the market. U.S. large growth tech, just regular large growth companies, large value companies, and small cap companies. The start of Netscape in 1995 through to mid-1999, large tech companies had a 760% increase. Okay? And some of those companies produced nothing, or they were very young companies. If we look today at what that looks like, large tech companies, going back since ChatGPT was released in 2022, have increased by 115%. It does not mean that their valuations, because they're high, are not going to result in a pullback in that space in the market. Nobody knows. But to draw a direct correlation to a bubble as if it's replicating what we saw in the 90s I don't think, frankly, it's a totally fair comparison. The companies that are leading this today are established companies that have revenue, that produce things, right? You are not talking about companies that just came, even NVIDIA, 30-year-old company, right? You're not talking about companies that are just coming on the scene that are blowing through the roof, that have no revenue and no business model that has shown any ability to profit. So I think it's quite different. Again, it doesn't mean it won't happen, but I think at least when people, if you hear it, rather than having some abstract fear that something bad is coming and that looks a lot like what that time looked like, hopefully you could settle in a little bit to know that it's really vastly different in terms of the level of expansion that we see today. Additionally, mega caps have outperformed. What this graph is showing is mega caps in the dark blue compared to the broader market. Mega caps have outperformed over the last 1 year. When you get out to 25 years, though, they have actually, just slightly underperformed. So if you think about all those things that we've kind of talked about through just the market-based portion of this conversation, what history says about something, or what the market says about something today relative to what we see as we extend out in slightly longer periods of time makes a huge difference in how we assess what we might want to kind of react to as an investor. And so evaluations are high. Now, if you want to diversify out of those, which we think is a prudent idea, here's the thing. You don't have to go intentionally reduce exposure to those companies. You can just do the fundamentally smart thing as an investor, which is not put all your eggs in the S&P basket, right? This is something that gets screwed up all the time, at least in my opinion, is this idea. And Buffett, for all the good things that he's done, he said, years ago, you could put all your money in the S&P 500 and you're going to be just fine. In the last 10 years, that worked. In 10 years from 2000 to 2010, what people in the S&P world, it's called the lost decade, where we had the dot-com crash, and then we also had 08, and we had 9/11 in there, all within the same 10 years. You got a 0% rate of return in that asset class, right? Well, when you get back to, if you invested all your money in the NASDAQ, 54% of your allocation is in those 7 companies. When you get to the S&P 500, you're at 35% of your allocation. When you get to the MSCI, now you're down to, which is the Morgan Stanley All Country Index, so now we're in a much more broad swath. Now you're down to 19%. So the message here is, if you want diversification away from concentration in things that you're worried about, you don't need to go in and like sell off of those positions. You just need to do fundamentally smart things, which will naturally move you away from some of the concentration that you might have in those positions, which most of you have with the design of how we have our portfolios built. This is the Big Mac Index. Some of you may have heard of this. In 1986, to compare the purchasing power of different countries. Now, what I understand, I took this slide out, maybe I shouldn't have, but I understand in other countries, like in Canada, I guess they have the McLobster or something like that, or the McLobster or something, and then in Korea they have the Makbogogi. So I don't know that it's totally, that it works exactly the same if they're not all made out of the same stuff, but what this really is to imply is something that was important this year in particular, which is oftentimes when we invest internationally, we think the return is a product solely of the return of the companies that we're invested in internationally. And that is not the only thing that comprises your return. Your return is also partly based on the performance of that currency relative to the US dollar, which is one of the reasons we saw significant benefits to international investing. If you can remember earlier, I talked about the dollar receding. The dollar receding left us to a place where we now have PE ratios, price to earnings ratios, right? Relationship between company stock price and its earnings per issued share. US is higher than it is internationally. You could beg the question, if valuations were driving your allocation, that there might be more return potential or more value in purchasing positions that are international than you might see in the US. And so I think that is something to consider. That is something you have seen with our portfolios, is to address that, right? To think about how we're allocated. Again, dim switch, not light switch, so you may not ever know that this is actually happening. Now, again, there's always data on the other side of these things. And if you look at historical differences between PE ratios. International stocks, on average, trade at 20% the valuations of US stocks, 20% less. Right now, if you look at the relationship between the 18 and the 27, they're 32% less, which is kind of a bottom end threshold. Okay, so they're not only are they low, but they're actually, maybe even more important, they're low relative to what they are historically, because they're always trading somewhat lower. So you wouldn't necessarily think there's value in there just because they're lower. You might find value because they're lower than the historical average, which, as you know, contributes to a lot of what we do from an investment perspective. I've shown this before, but the green represents the years the S&P 500 had, or the returns of the S&P 500. The blue represents the MSCI All World Index, and it's not been uncommon for them to go through decades of different performance. Don't necessarily flip-flop evenly, but it is common where in the 80s, international outperformed, or in the 70s and the 80s, international outperformed. In the 90s, US outperformed. Again, in the 2000s, international outperformed. In the last decade, US pretty significant outperformance. And obviously, we don't know what's going to happen moving forward. But what we do know is that market highs do not indicate anything about the future of returns. What these graphs show is that 1 year after market highs, 3 year after market highs, or 5 year after market highs, if we look specifically at just the S&P, after months where markets reach an all-time high, if you look 5 years out, the return is identical in the broader market return historically compared to when they hit all-time highs. Okay. Now that I see some eyes drooping, let's get into bonds, because this is really exciting. Now I'm almost done. I didn't keep the room cold enough. If we think about the stuff in the equity markets, I think if you've seen returns, you know that we've been fortunate that the probabilities that we lean into have been beneficial. Last year, maybe more so than some others. And these things are all being considered. The macroeconomic conditions and the adjustments that we make based on that are being considered. The valuations between US stocks and international positions are being considered. Concentration in holdings that might be adding more risk to the portfolio are being considered. What's not being done is prediction, because we see how abysmal those results are when you try to add prediction. The bond markets, there's some additional data, 2 slides left. This shows the volatility, if you go back over the last 4 years, of the 10-year Treasury. So what this is saying is the distance that the 10-year Treasury moved 4 years ago relative to today has progressively gotten tighter. That means we see less volatility right now in the fixed income space. Okay? Which is probably not surprising. It just means if we can get attractive yields with fixed income, and if markets are valued high, that's something we have to consider. In our balanced portfolios, it's something we have to consider about the ratios and targets of how much we own in different classes, not just the return that we're looking at, but the risk-adjusted returns that we might be looking at, which is kind of a boring technical conversation, but it is really important that not only are you getting return or being rewarded, but are you being rewarded commensurately for the level of risk that you're taking. And bonds obviously present some opportunity to that. The other thing is what's happened to the curve. What you're looking at here on the bottom, in the middle, is in July 3rd of 2023. It's this middle curve, the darkest, if you can see kind of the darkest line. Okay, we were in a pretty inverted yield curve. Inverted yield curve means short-term bonds were paying more than long-term bonds. That's not effective from a risk standpoint, right? If you're making more money in a short-term bond than you are in a long-term bond, who's ever going to buy long-term bonds? And long-term bonds have more risk than short-term bonds, so that doesn't make any sense, right? That's not a hierarchy of return that makes sense. That's what the Fed action is trying to do, is trying to normalize that, right? You see that if you get to the second, or or the next graph, the very top one, we started to normalize the curve, get to something that was more flat by October. And then by December, you see the bottom, which is what a normal curve looks like, a more normal curve in bond markets where the 2 years paying 3.4, the 10 years paying 4.8. That the combination of those two things creates a decent short-term environment for fixed income. I would argue in the equity space, we make less changes based on what's going on today because we have historical data about the returns of equity markets that drive so much of what we do. In the bond space, it's a little bit different because the historical data, if you use historical data and your subset has the 80s in it, right? That's a vastly different bond environment than we dealt with in the 2000s. So we have to not just invest in fixed income based solely on what the history has said about bonds, right? One of the reasons many of you in the room have annuities, right? And we have butted up against the norm, and it has been really painful, believe me, for us to stand confident and to stand pat with our recommendations that annuities can be a good alternative to bond space, right? We catch a lot of flack for doing that. Right? And it's really hard because people come in and they know everything there is to know about annuities and they know they're terrible. And then from a fiduciary standpoint, we have to, argue that they should be thinking about things different. And that's not to say you need them, right? But it is to say what we've been able to do with annuities over the past 15 years relative to the bond markets has been pretty significant. And part of the reason we got there is because we had to look at the bond markets in the time that we were in. We could not stomach being 60-40 investors when interest rates were at 1%. How could I possibly fall into the trap of what the history was saying you should be as an investor when you get older? You should have 60% of your money in stocks and 40% of your money in bonds. And I'm just going to accept that 40% of everybody's money is going to make 1 or 2%. That just doesn't seem reasonable, right? And so that's why we did it differently then. We still look at using all the alternatives not alternative investments, although we do use those too, but various alternatives that exist because this is a hard space. We saw interest rates rise. Now we see it fall. Curves are inverted. Curves are normal. I mean, it's just a really difficult space because of how involved the Fed is. And this is also not a political commentary, but the Fed is not independent. They never have been independent. They're either controlled by the government or the banks. They have some, they can argue their independence. I get that, but there's just a lot of forces that play into what the Fed is doing. And it makes bond investing very difficult, but what we're looking at is where can we get good yields? Does it make sense to go a little longer on the curve now because we can actually get some advantages in those spaces for being longer on the curve? And obviously when it comes to income planning, we have to think quite differently about the bond space. So don't panic, obviously. We're going to say that a lot. The news is going to have you think a lot of things about what's going on in the world today. We don't know what the result of that is going to be, and anybody who says they do is lying. And there are places, maybe avoid the gross generalizations, right? We can see parts of the market might be overvalued, right? But history doesn't say you can predict anything with that. Meanwhile, other parts of the market might be undervalued, and we need to be thinking about all of those things and continuing to think about the risk-adjusted returns. I'll get back to what I said earlier. We try to have a cadence, and we look to you guys when we meet with you to tell us how often we need to talk, right? Some of you who come to all of these and come to meetings, you could see us 5 or 6 times a year. That's quite a bit, probably more than you want. Other people aren't super engaged in other stuff, but at the end of the day, we've tried to build a team where we have people who, I'm in meetings a lot, obviously. I have other responsibilities, with my role at the company, but there are people who are available to take what you need, relatively consistently to answer questions. And if you guys feel like you need something, just know we've built out a team to try to make sure that somebody's there to answer that stuff for you and get you either escalated or de-escalate you, I guess, that's usually our job. But so we're here to try to continue to listen to feedback, get better, provide you with good information. I always regret that I'm got a lot of things running through my brain when I come in here, so I don't get a chance to sit and talk with all of you. But it's always good to see you guys. Thanks for your continued support, and keep an eye out for some of the upcoming events. By the way, in August, Apollo will be back. Yes. Apollo, if you haven't heard him speak, I may have to have him do it twice because this thing will fill up incredibly fast. He's so great, and he's all Q&A. So he has no presentation that gets stale because he'll just go off whatever you guys want to talk about in the moment. And hopefully, if we are going to see some volatility this year, hopefully it's concentrated to August so he can deal with all the really hard stuff when he's in the office. All right? Thank you guys. You guys have a good rest of your day.